Welcome to this Killik Explains finance video. This week, as we go into a new tax year, I thought I'd summarise an investor's guide to the tax year 2019-20. Now it is the personal taxes that I'm looking at. There are not many changes, which is, thank goodness, good news in a way, but here is the ones that there are. And if you want to know how these apply to you, because basically the impact depends on your personal circumstances to a large degree, then maybe ping me an email at the end. So, with no more ado, background to this is what? Well, the new tax year for individuals began on the 6th of April 2019 and it will run round to the 5th of April 2020. So we're in the new tax year. Changes for investors are fairly small from the last tax year. That's something of a relief in most cases. And here's a short summary. So we'll take each one in turn, each tax in turn, and take a look. And if you want more detail on this, I am in the process of updating my Killik Explains guide on how to save and invest tax efficiently. So do ping me if you'd like a copy of the new one for this tax year. Now, income tax first of all. So the personal allowance has risen to £12,500. Example coming up, but essentially, just to translate that, the amount you can earn tax-free in most cases, unless you're fortunate enough to earn more than £100,000, in which case it gets tapered away. But if you're below that level, you get a tax-free allowance of £12,500. The threshold for basic rate tax, which is the 20% rate, is now set at £37,500, which means the higher rate, the 40% rate, will kick in at £50,000. The 45% rate for additional rate taxpayers is way up at more like £150,000. That won't trouble too many people. So let's take an example of somebody who is, let's say, sitting on a salary of £60,000. How does that look? Ignoring national insurance, the first slice of your income is covered by the personal allowance, and that attracts tax of 0, so that's quite nice. The basic rate of tax at 20% covers the next £37,500 now, giving you a tax bill of £7,500. That's just the middle column times 20%. And then the rest, this is something sometimes people get wrong, earning £60,000 of salary doesn't mean you're hit on the whole lot of 40%, it's just the last 10,000 slice, because essentially 12.5 is covered by that, 37.5 is covered by that, so there's only 10 left to go, and that's taxed at the higher rate. The additional rate won't apply to you because your salary is not high enough to attract it. So ignoring national insurance, which will add a bit more tax on, your tax bill is going to be around £11,500, which is way less than 40% of 60, but that's because of the benefit of the personal allowance and the basic rate tax band. Now, capital gains tax. Not an awful lot to say here. There is an annual exemption which rises to £12,000. In order to use that, you've actually got to sell investments that would attract capital gains tax, like shares, within the tax year. And then you will get taxed, except the first £12,000 is tax-free. If you're thinking, can I roll this up year after year? No, not really. The way to protect very long-term gains from capital gains tax is another tax-efficient shelter like an ISA or a SIPP, for example. There are a few changes as well, which I won't go into the detail of here, to the entrepreneur's relief rules. Now, this is the government saying if you basically set up a small business and you run it for a while successfully and then you sell it for a profit, there are some ways you can reduce the capital gains tax bill as a kind of incentive to do it, if you like, to encourage it. So what they've done is tighten the qualifying criteria for the relief and the time period for meeting the conditions. They've squeezed it a bit, and to find out more about that, you might want to ping an email at the end, because if you think that applies to you, you need to be fairly pinpoint accurate on the new conditions. Inheritance tax is the third big personal tax, if you like. So logically, this is the tax on the death estate. What's happened here? Well, sadly, the nil rate band has remained at £325,000. Sadly, because it's a shame there's no inflation link there. So the real value of it is declining over time, if you like. But it means the first £325,000 of a death estate, assets left behind, is tax-free. And if you're a married couple, there's an easy way to get 2 of those, by the way. The residence nil rate ban, which was introduced fairly recently, it goes on top, is now £150,000. That means if your death estate includes your principal private residence, and there are certain other conditions attached to it, basically you can increase the tax-free amount above beyond the £325 by another £150 per person potentially. Now for ISAs, individual savings accounts, are useful tax-effective saving vehicles. So here the standard ISA allowance has remained at £20,000. And by the way, you don't have to wait till the end of the tax year and rush to use it. You can start using it on a monthly drip feed basis whenever you like, but it's still £20,000 for the adult ISA. The junior ISA allowance, which is the same vehicle, for kids, if you like, has risen to 4,369. Slightly awkward number, but essentially we've got a little bit of a lift on last year's allowance. And then pensions. Now, the pensions landscape has changed enormously over the last 5 years or so. So fortunately, Philip Hammond didn't do too much in the last autumn statement to move the goalposts here. So what do we got? The annual contribution limit stays at £40,000. That's the amount you could pay into a personal pension to get tax relief on the amount subsequently. And that basically is capped at £40,000. Now there are conditions. You need to have net relevant earnings that are at that level in order to get the full 40. You can boost it by bringing forward prior year unused allowances, and it's capped, just to add to the confusion, if you earn above a certain level. But the starting point is an allowance of £40,000 as it was last year. And then the lifetime allowance has been tweaked up. That caps the amount of benefit you can expect to get from a personal pension pot, essentially. That's been tweaked up to just over £1 million. And just worth bearing in mind, there are protections you can apply for if you've accrued higher amounts than that before this tax year. Let's mention that in passing. Okay, so lots of little bits and pieces really, nothing substantial. To find out more, because tax is a personal thing, your circumstances will dictate how exactly this applies to you, then editor@killik.com is not a bad starting point. And if you'd like to see videos that explain some of the taxes I mentioned in a bit more detail, because this was just a snapshot, then it's killik.com/learn tax effective saving, or you could request one of my new tax effective savings guides in the Killik Explains series, the how-to guides, and again, ping me an email if you're not sure where to find those.